Steve Wendel, he's the head of behavioral science at Morningstar. He joins us on the show right now. Steve, pleasure to have you on the show today. Thank you so much for joining in. You know, it's often said that if you buy fear, you will be rewarded in the long term. Is it time now to really buy fear? Because it's easier said than done, Steve.
Sure. So again, it's very difficult to make a statement about the overall market. And so as a behavioral scientist, I focus on what we can know, right? And I can't predict the market any better than anybody else. But I can say, okay, given an analysis of the underlying fundamental value of companies, where does it look like there might be, if I have cash on hand, looking at where might there be an opportunity, right? So that's what I focus on, not so much is now the right time, but rather, is the price right? Is it something that it's appropriate to now think about rebalancing if our stocks are down and our alpha allocation is out of whack? How can we remedy that?
So, Steve, what's the message to the viewers who are watching this interview right now? Time to load up on equities, or is it time to go back to the drawing board and reallocate and refigure how you're going to asset allocate?
Sure. Well, I think first and foremost, we have to look at our own goals. We have to look at, are we on track for what we want to accomplish? And if we still are, then great. Let's look at our plan. Does our plan say that in order to, that in the long term, we should have an asset allocation of, say, 70-30? Okay. Well, if the decrease in stocks, decrease in stock markets has brought that out of whack, okay, is this a reasonable time to reinvest? I'm not a big fan of trying to read into the markets and saying, now's the time, go buy, or things are going crazy, go sell. It's so difficult to make those predictions, and rather we can thoughtfully analyze our long-term goals and see what's the incremental steps we can make right now that keep us towards those goals.
Right. Steve, you know, when as a young journalist covering the 2008 crisis, 2008 was described as the worst financial crisis mankind had ever seen. People are using the same terms right now. So, I mean, is it coincidental that the same phrases are repeated, or are we seeing something far worse?
Our minds look for patterns in everyday life. And when something seems out of pattern, it sets off alarms, right? Now, does that mean that this is somehow either better or worse, or the long-term trajectory is going to be anything like the 2008? I think the most honest answer is we don't know. And even better, no one really knows. We're only going to know in hindsight. And it's so easy to make to try and forecast into the future right now. And there's not much basis for that. The best we can say is, where are we now? What are our goals? And what incremental steps do we need to take? Because your guess is as good as mine. And I think that's probably the safest place to be.
Okay, the world has also changed to algo and machine-based trading, which follow patterns rather than human behavior. We've not seen such loose monetary policy. How do you see this impacting future returns?
Sure. So at an individual level, there is a natural and understandable fear of what's going on in the markets right now. And we know that a number of our behavioral biases, or shortcuts that our minds use, are being triggered right now, right? So in particular, vividness. So the things that easily come to mind because they're vivid or because they've happened recently, which is called availability bias, it feels like that is true, and it's going to take control over, it takes a certain control over our thoughts. And so that means that, for example, in the recency bias, if we see that the stock market has just dropped 10%, it is natural to assume that it's going to continue to drop that way. Because in our everyday lives, these rules make a lot of sense. The problem is, these rules just don't apply to the markets. We look for patterns, we try to apply this in the markets. And so, for example, if we look at the algorithmic trading that you asked for and say, okay, what does this mean for what the market's going to do? Our minds will naturally try to give us an answer. But we should be really, really wary of those answers. No one knows, and our minds are going to try to find a pattern. They're going to try and find an answer to what's going on and what's going to happen over the next few days, what's going to happen over the next few months. I think, again, the best answer we have is we don't know, but there are some things we can control. We can control our own behavior. We can control our own actions, because it's quite possible that other major players in the markets have already priced in the fact that things are that there are major algorithmic training out there. Have already priced in the fact that this is a global pandemic, and so that neutralizes anything that we might come up with individually. We have to be real careful there. I hope that helps answer your question.
Right. Steve, seasoned investors always say don't look at where the puck has moved, but where the puck is going to move. How is it that you're staring and looking into the future? What's it holding for us?
I have to admit, I'm skeptical of both. I'm very skeptical of an individual's ability, or for that matter, a company's ability, to assess where the puck is going to move. Instead, again, I look at what we can control, which is, I'll tell you myself, I put in a number of buy limit orders and say, okay, I believe that the market has that the companies that the markets represent have a fundamental value, and I don't know where the market's going. I don't know whether it's going to go further down. I don't know whether it's going to further up. But this is a reasonable margin of safety for me to buy. That's how I approach it. I know it's different. It's neither trying to look where the puck went nor where it's going. It's rather, where is it right now? And is it appropriate given my long-term goals to rebalance or make some incremental action?
Right. Steve, so when you see this kind of an unprecedented meltdown, everything from equities to gold to commodities to cocoa to what have you, it's all falling down. And at a time like this, how is it that you go on planning your goals? Because equities are a volatile beast, but for the long haul, they are a good investment bet. So how is it that you take that judicious call on how to plan your goals at this juncture? Because that's really step number one of investing.
I think it's not clear that the core pieces have been challenged. So long-term returns for stocks have outperformed, at least in the U.S., right, my context, which I know best, have outperformed bonds over the long run, right? We see that in times of volatility, often stocks and bonds move in different directions, but not always, right? We see some significant correlation right now. And so short-term volatility does not mean the fundamentals of one's goals and the fundamentals of stocks generally return a certain percentage over a long-term period and are the best way that we've found to build wealth over a long period. I'm not sure that those have fundamentally changed. And again, I'm not saying that I have any crystal ball, but rather I embrace a certain level of not knowing.
Steve, over the years, information has become very synchronized. Exchanges, regulators have ensured that information reaches all participants at the same time. Has investor behavior changed over the years on account of that?
Sure. So we can have a tremendous wealth of information at our hands, and we can be overwhelmed by it. And so I look as a behavioralist, I look at what information is getting through and how does that affect us. And ironically, there have been a variety of studies that show that the more frequently we check the markets, the more frequently we get market updates, the more that we focus on that, the more that it warps our behavior. The more that it, in particular in these studies, makes us risk averse. And so, sure, we may have all the information in the world, but that doesn't necessarily mean we'll make better decisions. We're still human beings, and we still have these challenges. And so age-old techniques, even in a rich information environment, are important. You're going to have to focus on something. And so rather than focusing on the minute up and downs every moment, focus on your goals. How are you doing towards those? How do you control that information environment so that, yes, even though everything's possible and you could be seeing what's going on everywhere, how do you resist that temptation and just look at what metrics matter for you and for your life? And again, how do we step out of this, trying to find a pattern? How do we step out of this tremendous temptation to say, I think the market's going to do this, I think the market's going to do that, right? These are age-old wisdoms. We look back at Buffett, right? We look back at the founders of thoughtful long-term investing. And it still applies.
So I guess the biggest question of all then, how does one keep calm in the face of such a meltdown?
Yes. So ideally, the advice is keep calm, right? And for some people, that means taking a break. For some people, that means meditation, whatever it might be. But honestly, sometimes you can't keep calm. And so what do we do given the fact that we're human beings with emotions? Well, there are a variety of techniques we can use here, right? One of which is to externalize, is to say, okay, I know I'm feeling like I need to take action right now. Okay, let me write down the rules that I will follow. For example, when PEs are at a particular ratio, right? Or when the market drops this particular percent, then I will evaluate this. Write out those rules so there's a chance for you to look at them in a calm, thoughtful way. That's externalizing, right? Getting it out of your head and onto paper so that you can review and edit. And the only thing you do is follow those rules. You can change them. You have to keep them for a long period. You can adjust those rules as you learn, but that's one technique, right? To, even if you're feeling anxious, even if you're feeling fearful, to take thoughtful choices, right? Another one is to understand that we are going to be tired. We are going to be overwhelmed. That's human. So look for those moments when we're most overwhelmed, most tired. Stop, take a break, and rest, right? Sleep, the amount of sleep we get really matters, okay? We can also look at the action bias, right? It feels fundamentally unnatural for us to not do anything in the face of turmoil around us. And so what do? Well, we do take action. One way we can do that is in a bucket strategy, say, okay, I have my long-term goals, long-term needs. I have my saving for the house, saving for kids' education, whatever it might be. And then I have my short-term, right? I have my short-term goals. Okay, that's the place where I can take action. And I'm not going to interfere with my long-term projects, right? I'm not going to interfere with these long-term goals. So it's taking action in a very constrained way. Or that action could be setting buy limit orders, right? Thinking about what are the rules you want to follow, rather than action being, oh man, I need to get out right now, right? So those are some techniques that we can use: externalizing, addressing the action bias, as well as understanding that we're going to be overwhelmed and looking for how we take care of ourselves.
Important things to keep in mind, Steve. Thank you so much for joining us and sharing that.